Hello everyone, and today I'll be showing you why I believe the equities markets have bottomed out. Now this is a chart of the RSP, which is the S&P 500 equal weight ETF, which instead of the SPY, which is a market cap weighted index, this just gives equal weighting to every 500 stock in the S&P 500. As you can see, it's looking pretty strong right now, simply because of the fact that it's gone up quite a lot on positive volume, on high positive volume, and in the current retracement it hasn't actually gone down that much, and on quite light volume in comparison to the previous up volume. That's all very positive. Compare that to the triple Q, which is the Nasdaq 100 ETF. Of course that looks a lot weaker, simply because tech stocks have taken a battering over the past 12 months. While I don't think that the Nasdaq is going to retest those lows in the mid 250s, I think that it's going to retrace a little bit for the next couple of days, if at all, and then possibly bottom out in cadence with the rest of the market. Now moving on to the DJT. Now the DJT is the Dow Jones Transports Index. This is a very good economic index, economic bellwether index, to gauge the strength of the underlying economy overall, and it looks a lot stronger than both the RSP and the Nasdaq, and this is already starting to rally, as you can see, on a daily basis ahead of the other markets like the RSP and the triple Qs. And I think the other markets will follow, and that Dow Jones Transports will continue going up. Tesla is getting murdered, isn't it? I mean, look at that, it looks atrocious. But just because Tesla is crashing, it doesn't mean the rest of the market will, right? Tesla is trading on an insane PE ratio of about, I don't know, like is it 90 or something now? And as you can see in this chart, which shows the growth versus value comparison, so the higher the number, it means the more weighting there is towards growth stocks, and the lower the value, the more weighting there is towards value stocks. It shows that the growth to value ratio peaked in the year 2000, which is when the dot-com bubble popped, and that was the height of the dot-com tech bubble, and it fell to as low as around 0.7 in 2007, it seems, and that's when growth started catching up to value, and it was only until recently when growth was really outpacing value. But since 2021, that relationship has completely flipped around, and it looks set to continue as the growth to value ratio heads towards 1, and I think it can go even lower than that. I think it'll end up probably around the same as before, maybe not as low as 0.7, but I think it could really go to around this 0.8, 0.9 level, and who knows what will happen from then on. So what does that mean? I think that tech stocks like Tesla will continue tanking as their PE ratios compress further, and I think I'm not going to call where the bottom for Tesla is going to be, because no one knows, but I do think that tech stocks are not really the place to be right now. I think that there's going to be further PE ratio compression, even for stocks like Meta, which is trading at around 10 PE ratio right now. Now this is the chart of the percentage of stocks above the 200-day moving average. I'm assuming this is all stocks in the NYSE exchange. And as you can see here, this ratio, this percentage, actually looked like it bottomed out at around the 15% mark a couple of months back. It actually had a double bottom. First went down in May, and then it tried to go further lower in September, and then it just bottomed out, and basically it's rebounding, and it's rebounding quite strongly. And as you can see, if you look at all the previous times that this percentage has gone below 20, pretty much within a month's time, the percentage has gone back up above 30 in the next month. And that's what we're seeing this time around as well. And I think there's more to this rally. And then just going back to that whole growth versus value argument, this is the Dow Jones Industrial Average, the performance of the Dow Jones Industrial Average Index compared to the performance of the triple Q, which is the NASDAQ 100 ETF. And as you can see, the Dow Jones Industrial Average has outperformed the triple Qs by some margin. And I think that's because of the savage rotation away from growth, profitless growth. I know some of it's profitable, but a lot of it isn't. So the next slide shows the number of companies who are revising their earnings either upwards or downwards in aggregate. And it seems that the last month, October, more companies are indeed revising their estimates, earnings estimates downwards, but it's not really catastrophic, is it? It seems to be a pretty routine cyclical period we're going through where, earnings revisions are negative, but not catastrophically so. As you can see, the bottoms are much more severe in 2008 and 2020, and we are nowhere near those levels. One thing to look out for tomorrow is that the RBNZ, which is the Reserve Bank of New Zealand, is one of those sort of forward-looking central banks. A lot of the bigger central banks will be paying attention to what the little RBNZ is going to do tomorrow in terms of how many basis points is it going to hike its main sort of interbank fund rate. Most economists seem to be predicting a 75 basis point rate hike, but, and this is a huge but, if they go only 50 basis points, that could be extremely dovish, and that could really light a fire under the equities market globally. So keep an eye out for what the RBNZ does tomorrow. I think even if it does hike by 75 basis points, it shouldn't be that much of a worry for the markets, and especially if the central bank governor over there comes out and starts saying things that may be deemed dovish, that could also be positive for equities going forward. But I do believe that we could be trying to test the prior low that was set at the start of the month, the near-term low. But if it doesn't even get there, and if it only gets, say, halfway to that point, that could be incredibly bullish, and we could be due for a huge rally, relief rally at least going forward, and to finish off the year. So keep an eye out for that, guys, and happy investing.